thanks for the invitation. Definitely, I really appreciate that. So this is a relatively new project with Tom Lee, Siddharth Naik, and Andrew Papanikolaou. So Tom Lee is from NYU and Andrew is from NCSU. I'm from the University of Turin, the Collegio Carlo Alberto, which is kind of the business school. And the paper is called Implied Impermanent Loss, a cross-sectional analysis of decentralized liquidity pools. And the title already reveals about what the paper roughly is. It's basically about implied option, implied information. So what can we infer from derivatives? So here derivatives on Bitcoin or Ethereum, for example, and connecting this with liquidity provision on decentralized exchanges, like in Uniswap, for example. And so that's more or less the situation. It's basically this picture. So we know that there are liquidity pools on a DEX with an AMM. And if a liquidity taker, like a trader, wants to swap, he or she can do that in a liquidity pool. For doing so, the trader pays some fees to the protocol. The liquidity pool automatically, the AMM basically adjusts the prices given a rule, for example, a constant product rule like this one. And on the other side, we have a liquidity provider, the LP, who basically takes the tokens, spare tokens, or any liquidity he or she has, puts them in the liquidity pool and earns fees on that. Namely the fees which pays the liquidity taker, part of the fees. Part of the fees also stays in the liquidity pool. So this AMM basically, we know how that works, is that there's for example, this constant product function rule, which says that the total liquidity should be the product of the two tokens. So whenever you take one token out or some amount out of the token, for example, you want to remove one token from the pool, you have to add delta one many tokens on the other side so that the liquidity in the pool basically stays the same. Now this sounds all really good. What's the risk for the liquidity provider? The risk for the liquidity provider, besides like protocol risk, hacks, all of that, is the so-called impermanent loss. And this impermanent loss is basically due to this functioning of these AMMs, the way they are set up. So there's no order book, right? We have this AMM, you can trade with the AMM anytime basically. And so if the value of one of the assets changes, then arbitrageurs enter the pool and they trade at the stale price in the direction of the price change, and they minimize the pool value. So basically this impermanent loss is adverse selection for the liquidity provider. And I would like to make actually an example, because this is often, I mean, it's the most important part basically of the paper to understand what is impermanent loss. And this example brings it well to the point. So let's say we have a token one, which is worth 100 USD, and there's a pool and the LP adds 10,000 USDT and 100 token one to a liquidity pool. So he adds 20,000 USD to the pool, 10 each. The pool now contains 100,000 USDT and 1,000 token A. So basically the LP owns 10% of the pool. He added 20,000, the total is 200,000, so he or she owns 10%. Now, as I said before, whenever one of the prices changes, for example, token one increases from 100 to 150, what will happen? Traders will enter the pool, because in the pool there's still a one-to-one relationship, or not one-to-one, but one token is worth 100 USD. In the outer market, on the SEX, for example, it will be 150. That's what happens. So what happens is traders will enter the pool, they will add USDT, and they remove token one. So they basically they buy the cheaper token and sell it outside. And how long are they doing this? Until the ratio is, again, 150 to 1. So arbitrageurs enter and they will adjust the prices so that the price in the pool will be the same as the price outside the pool. So let's check what exactly happens. So we know that this X times Y must be 100 million. This is just the product of X times Y in USDT or in USD. And then we have this ratio X over Y should be 150. So from these two equations, we can solve for X and Y. that's the math. I guess you can believe it. So basically what happens, before it was 100,000 and 1,000. Now the ratio changed. So we have 122,000 token one, USDT, and 816 token one in the pool. Because using these numbers, you solve exactly these two equations. Now the LP withdraws 10%. That's still his share of the pool. So he has this and this amount of token one, and this sums up to 24,500. Now you're saying, great, he actually or she made a profit of 4.5K because she added 20,000. Now it's 24,500. What's the problem? And impermanent loss is basically the value of providing liquidity as comparing it to the HODL. HODL means basically you just hold the tokens. So what would happen if he or she would just hold the token? So that would have been 10,000 USDT, that's the beginning, and then the 1,000 token one, which are worth 150 now. So basically 25,000 USD. So basically this impermanent loss is kind of the difference by buy and hold and providing liquidity. What we don't consider here is the fee revenue from trading, right? Because there was trading, they will earn. So this is not exactly, this is the impermanent loss, but you have to set it off with the trading. And this is basically an example of impermanent loss. And I hope now that it's clear what I'm talking about by an example. So what we do in this paper is basically that we connect the risks and returns from this on-chain liquidity provision to the derivative market. And option implied information, for example, the VIX, which we all know, gives us some expectation of innovations in the prices of the underlying token. And the main issue here is that we cannot use just the VIX as a measure of risk in this decentralized liquidity provision, like we do it, for example, for the S&P 500, because in liquidity provision, it's important it's important to measure the relative price. So how do things change together simultaneously? So inspecting just the VIX for Bitcoin would not give us all the information to really measure the risk of liquidity providers. And I will show this later in more detail. So what we need to do is we need to really replicate this option implied impermanent loss. So not just the variance of one token, but the variance of the relative price, so to say. And we show that this implied impermanent loss can be decomposed into the token volatility. So that's like the BVIX or the VIX of ETH, but also a correlation component, which is actually really important. And we replicate, we provide the mathematics for replicating this, but we also quantify this implied impermanent loss for Bitcoin ETH token pair, which is the largest pool on, for example, Uniswap. So it's one of the most traded pairs is BTC ETH. And why? Because for these two tokens, we have a liquid option market on a SEX, basically. We then show how these measures are related to pool sizes, so TVL and future APRs, and also that these measures are able to explain the cross-section of returns from liquidity provision, so which is yield farming. So that's more or less the paper in a nutshell. So there is obviously some literature. There's a lot of literature on liquidity provision on DEXs and impermanent loss by itself. The literature on option implied information is mostly on equities. So there's one paper by Carol Alexander and Imaja, which talks about the Bitcoin VIX, but the rest is mostly on equities. There's also a VIX and all these measures for other asset classes, but not for crypto, let's say, and not for in the context of liquidity provision. So I did my PhD in implied correlation. So this was an interesting way of inspecting this from a new angle. So what is the economic mechanism which we basically discover in the paper which I'm showing you at the end of the paper? So NLP is providing liquidity in a pool, and then there's innovation, one of the prices, or in the tokens, or in both of them, not necessarily in the same direction, somehow. What happens is that arbitrageurs will enter the pool because one token prices changes. And what I told you before, if there is some mismatch, arbitrageurs will enter and will trade and make a profit. So which leads to the fact that this liquidity provider basically experiences impermanent loss. But at the same time, there's also more trading activity in the pool because people trade the arbitrage. So there must be a higher gross APR. It's important that it's gross APR. So there's a link basically between these shocks in fundamentals. So Bitcoin goes up, for example, and impermanent loss and returns on liquidity provision. And the idea is roughly that we get this expectation of moments of price innovation by option implied information. And so big part of the paper is the mathematical framework which we developed. So basically,
can I ask a question?
Sure, of course. Say it again.
Can you go back?
Yeah.
So for 0.5, the idea if it's only a shock of the prices that only arbitrager will trade. So even that you get fees from the arbitrager, you're still going to end up with a loss because there is like no, let's call them noisy traders that will trade, let's say, to get the arbitrage profit, and my internet is not stable.
I was just wondering if it's mine or yours.
Sorry.
No, but I mean, I think
So my question is that it's higher APR, but not necessarily in a way that it's compensate your impermanent loss, right?
Exactly. Yes, that's most likely. So what you want ideally is a lot of noise traders, no fundamental shock. People trade one against the other, but the prices kind of stay the same. You earn a lot of APR, and you don't experience impermanent loss. Here, basically, the channel which we investigate is that how is this impermanent loss connected to the APR? So coming from the price change, not from noise trading, let's say.
Okay.
Yeah.
Thanks.
So exactly doesn't mean, that's why I'm saying cross APR, because it means just APR without subtracting the impermanent loss. So like gross return you can think of. Yeah. So that's important.
Can I have a follow-up question? So usually,
of course,
when we talked about impermanent loss, you have to think about a time window that, you know, whether it's a day, a week. Should I think about the option? Should we think about these as the same time frame as the option implied information would be, or how should we think about these time windows?
Yeah, that's a good question. So basically, the options are written daily, weekly, monthly, yearly, but yearly is already really illiquid. So most trading happens in short term, monthly, and I mean here there are no options basically there yet, right? I'm just explaining that more impermanent loss will translate into higher gross returns. But the question is, since there are shocks in fundamentals, is this basically captured by option implied information? Like, for example, the VIX tells us something about the volatility in the future, if we believe in that, so to say. So can we somehow identify shocks or expected shocks or changes in the underlying using option implied information? But in this picture, there are not yet the options. I mean, it's rather at the end. So we want to get an expectation of this shocks or price innovation through option implied information. You could also use realized, for example, realized volatility as a measure of future realized volatility, and then get some expectation about the impermanent loss as well. This idea is basically using the options without any realized information, but we also benchmark against realized information. Yeah. Yeah, so basically in another paper, previous paper, so this is the follow-up paper, we developed the theory, we started with the theory for the impermanent loss. And we basically start with two prices for tokens. There are two Brownian motions and they're correlated. And we show, and this is in the first paper, which you can find here, but also this can also be found in some way in other papers. The Lever paper, for example, that's a special case, that the impermanent loss is basically the variance of the relative price. So the variance of the relative price, that's kind of it's proportional to the impermanent loss or to changes in the impermanent loss to this DIL. And the volatility of the relative price can be written like this. So this is coming from McGrath theory from the 70s, but you can basically decompose it as the variances and the correlation. So this is the variance, this is the volatility of the relative price. So this impermanent loss in this model is a function of the token variances and their correlation. That's kind of the first thing. Now the question is, we want to replicate this under the risk neutral measure using option implied information. And now things become a bit more, I mean, if you're not familiar with this replication theory, yeah, a bit trickier, but I've tried to explain it in simple terms. So basically the volatility swap, the literature on the volatility swap basically showed that you can replicate a variance using the lock contract. So you can show that you can replicate the variance, which is, I mean, the integrated variance, using the lock contract and a total what do you call it? A total return component. And typically in the case of like stocks or anything like that, or when you do the VIX, for example, the VIX calculation, this first expression here is kind of a short-term, can be approximated using a short-term interest rate because it's a martingale. The second thing is this term then will be written as a function of call and put options. So if you know the VIX equation, for example, this left thing is kind of the VIX on the relative price, and it can be written as calls and puts together. Now there are two issues here. The relative price, and these are the two primary challenges when we do this evaluation, is that the relative price is not a martingale under Q. So this thing here cannot just be written as a short-term interest rate as a function of a short-term interest rate. What we do against this is we utilize a change of numeraire, which is the classic thing. So typically when you learn about Black-Scholes, you go from P to Q, you do this change of numeraire. Here we go from Q to another Q measure to get rid of this component. The second issue is that you cannot replicate this thing with calls and put options so easily because there are no call and put options on the relative price. You only have call and put options on a single underlying like BTC, like Ethereum, but you don't have call option on BTC over Ethereum. You only have it in BTC USD. So we cannot really replicate this part as well. So what we need to do here is we need to compute a joint density from existing options, single options, to calculate this remaining part. So, and these are the two main challenges we had in this valuation. And I mean, I can give you a bit of an idea how this is done, but essentially it's measure theory and stochastic analysis. And what we do is we define a new probability measure, Q tilde. It looks like this, and this is kind of the change of numeraire. And you can show that under this measure, you basically divide through one of the tokens. This relative price becomes a martingale. That's important. And for example, this technique is used, as I said before, in the 70s. So when you want to evaluate a call spread, you can basically, call spread is defined as this. It's one token or stock minus the other. And you can show that this, or the theory then says, this is the same as an option on the relative price under another measure. That's where this theory is kind of coming from. And changing this measure we can basically allows us to calculate, and we don't need these calculations here, but just to give you the idea, this expectation of this impermanent loss, which is by definition this thing, the expectation, the integrated variance of the relative price, which is by definition this thing. Using this new measure, we can basically change the dynamics of P1 and P2 using Girsonov theorem. We can then evaluate these two things, and we get exactly what we wanted. We wanted that this thing is basically just a lock contract because R is now a martingale under the Q measure. So going back here, we kind of, this term does not exist anymore under the new measure, and all what I just showed you was the reason for that. So what we have remaining is basically this right thing here. Now the question is, how can we evaluate this right thing, the lock contract for the relative price? Because there are no options on the relative price available. Again, we have to use some tricks here. So basically, let's assume we have a risk neutral. Let's assume for a moment we would have a risk neutral joint distribution Q for these two tokens. We could then construct this measure here following my graph, and we could then value this expectation because we know the tilde measure basically. The big question is, how do we get a risk neutral joint distribution? And therefore we rely on some economic theory. It's the Hansen and Jaganathan bound. And this is something we teach in the Masters in Finance, for example, that if you have an excess return and the pricing kernel, you get this identity, and this HJ bound on the Sharpe ratios basically gives you a lower bound on the pricing kernel. So the volatility of the pricing kernel must exceed the Sharpe ratio of this excess return. And this HJ bound basically motivates us to find like a suitable pricing kernel that minimizes that bound, and the pricing kernel is a function of the risk neutral measure and the physical measure. The physical measure we know, the risk neutral measure we're interested in.
Can I ask you?
Sure.
Sorry, I'm not familiar with this literature. So the risk neutral distribution, means that you assume that the agent is maximize expected payoff. This is like...
No, the risk neutral measure means that, for example, in the Black-Scholes world, means that the stock has the same expectation as the bond, the coupon, like the R, the risk neutral.
The riskless.
Exactly.
Okay.
In this world, with changing the numeraire, you basically assume that it's not the R, it's like the other. It's the other token kind of. But this one you can think of the same as I just said. This is basically the risk neutral measure you know from Black-Scholes, kind of.
Okay.
Yeah. Exactly. And this method here is detailed in this paper from Guazzoni, Meyer, Hofer, also in terms of optimality and uniqueness of the solution. Basically, one can then do an ansatz. This phi ij is a function of this q and this p. One can calculate this right-hand side, and it turns out this is basically the square of these things. And we then solve an optimization. Basically, we are searching exactly this right-hand side here, the minimum of the volatility of the pricing kernel, which we figured out is in that form. But we want to constrain it, saying we want that the marginal distributions, they remain. So basically, we have the marginal distribution of Bitcoin, we have the marginal distribution of Ethereum. We can totally, using derivatives, we can extract them perfectly. Now we want to minimize kind of the co-movement between them, so the joint distribution, which is this thing here. And we obviously, since this is a probability, we want that this thing is positive. So this is kind of the optimization we are solving in the next step. And once we have a solution, so we have this phi, we can then, from phi, we can calculate Q because we know P. Once we have Q, we can go to Q tilde here. We just plug in Q, and this in this equation we get Q tilde. And once we have Q tilde, we can finally calculate this expectation by multiplying probability times value as you would do it with a simple experiment, more or less. And this thing we call implied impermanent loss. So you see there was a lot of machinery which I basically try to explain in short to get this, because we have these two problems. The first is that it's not a martingale. The second is there are no options on the relative price. We need simple singular options, basically. And then we estimate this for the Bitcoin ETH pair. But we can do even more, actually. We can also get an implied correlation. And if you ever heard about implied correlation, so this is also something SIBO, for example, they have an implied correlation index. It's kind of if you think of the S&P 500, you take the correlation matrix, you average it twice, you get one number, which is the realized correlation, the average correlation of the S&P 500. And you can do exactly the same for options. So you can get an option implied correlation. And typically an option implied correlation, you can only infer from if you have basket options. So this is the identity here. This is what we teach in the masters. The variance of an index is basically this weighted sum. It's the variance of the portfolio the index represents. And this is one equation. And we know the W's, these are the weights. We know the sigmas, implied or realized, whatever. And if you assume that this thing is constant, you can basically calculate this one single number, which gives you the average correlation index from options or from realized data. The problem is, again, there are no traded options on an index on cryptocurrencies either. So you only have options on BTC or ETH or Solana or other options, but there are no options on any basket. So this left-hand side here is basically not existent. What we do in order to get something out nevertheless is we basically use our Q measure, which I just showed you how we get it, to price a spread option. So we price the spread option using our Q measure. We then back out the implied volatility on the relative price. And we then use Markgraf equation to back out the correlation here using this identity. So basically, through our Q measure, we're also able to extract an option implied correlation. So we have these three components, basically. We have the correlation, we have the variances, and then we have also the implied impermanent loss. So these are the four things now we're dealing with, so to say. Okay, I think I talked enough about the math and so on, but it's important because it's kind of the big part of the paper. So let me give you some idea of the data. So this left-hand side here is the impermanent. This is the realized impermanent loss. So I just use realized pool data and I calculate the impermanent loss on a V2 kind of style. So there's a simple equation for that. And this is annualized. And this is the cross-sectional average. So I take 100 or 250 pools, I calculate the impermanent loss each day, and I average across these 250 pools. So you have one number a day. And you see that the impermanent loss on average is like 7–8%. You have extreme outliers up to 18%. On the other side, there's the return. So here, when this whole thing started, APRs, it's the same calculation, APR for each pool, for each day, average. So we have one average APR, and we see that this average is about 15%. Tendency is decreasing. So, I mean, at the beginning, obviously this stuff was way more, it provided higher returns. Now over the past, things became more efficient. So there are less returns. So you see, you can experience high drawdowns here. If you face 18% impermanent loss, but only 5% APR, you have a large loss basically. On average, nevertheless, using these numbers, liquidity provision is sustainable though. But there is a risk and return relationship. So this is realized data. I just want to give you an overview about the universe, so to say. Now let's talk about the options data for a second. So basically we use Deribit data. Deribit is the largest DEX for options trading. As I said, we focus on BTC and ETH, 30 days to maturity, because these are the most liquid options. We get surface data from embeddata.io. We can then calculate the risk neutral distribution, like the whole thing. We can also calculate VIX kind of measures like SVIX, or you could also calculate CBO VIX. It would look almost the same. And we also call this calculate this implied correlation using that trick I told you before with the spread option. So we have these four measures. And we also obviously calculate the implied impermanent loss. So let me show you how the implied impermanent loss looks like. Let's start with the right figure. Here you see the realized. So now I'm focusing only on the BTC ETH pool. And the first thing you realize is that this realized impermanent loss is a really noisy measure. So you have so this is annualized. So this amplified by a lot. Obviously it's daily. It doesn't look like that. Even it's daily data, but it's annualized. So you have a really noisy signal, but you see the blue line kind of co-moves with it. And so here the realized one, this orange is 2 days rolling mean. Here I took a 30-day rolling mean because I used 30-day option. So to make the two figures more comparable, we applied a filter to it, and you see that there is a really good co-movement between the realized impermanent loss from the liquidity pool data and the impermanent one, the implied impermanent loss from the options data. But this is important, as you see, sometimes the realized exceeds the implied. And this is what you also see if you look at S&P VIX, for example, variance risk premium, you see the VIX, and then sometimes you see realized volatility is typically lower, but sometimes realized volatility exceeds the VIX. And that's when basically this is the variance risk premium kind of. And the same happens here. It just depends on on which frequency you look at. So here, for example, all these spikes, realized exceeds implied, but on average, implied is larger than realized. So this is relatively, it's similar to the variance in the equity market, basically. These plots, that's now BTC, implied volatility, and ETH. This is kind of the VIX measure for BTC, and yeah, this should be ETH here. Oh, it's the same plot. Okay, it's the same plot. It should be another one, but the right side looks similar basically. So you have the BVIX, for example. This is it, and you also see the same thing. Sometimes the realized measure exceeds the implied measure. On average, implied is larger than realized, though. So this I should change. Yeah. Now let's look at the correlation. Also really interesting. Correlation is between BTC and ETH. So the orange line is the realized one. So I just take the correlation coefficient of these two tokens, and you see it's high. On average, it's really high. It's like 80% something. So tokens are highly correlated. Also, implied correlation is highly correlated of these two tokens. So overall, the pictures, the implied version and the realized version, they fit well together, I would say. Sometimes you see these spikes again. Here, the spikes are going down. And that's a really interesting fact about correlation, because we learned so much about diversification that correlation should be low. Don't put all your eggs in one nest. You need to diversify, which basically means it's good that you have a low correlation. For liquidity providers, it's exactly the opposite. Liquidity providers want high correlation because if things move together, the relative price doesn't change and you don't experience impermanent loss. So actually here, being diversified in a liquidity pool is a bad thing. You don't want to be diversified. You want strong co-movement between the two tokens. And that's an interesting feature of implied correlation, which is not present in equity markets, because there you want diversification most of the time.
Sorry, can I ask
yeah.
a quick clarifying question? So the implied correlation comes from the Q function. What's the realized correlation here? That's the price on the options themselves?
No, that's the two tokens. So you take the ETH returns, you take the Bitcoin returns, and you calculate a correlation, the correlation between the two realized time series, and you just do this over a 30-day window. So each day you get one correlation coefficient calculated over the last 30 days. And this is basically the orange line here. So it's just realized token data, and you just calculate the correlation here.
And this price comes from centralized exchange, I assume?
This comes from, yes, this is from a centralized exchange. So it's not the price in the liquidity pool.
Okay.
I mean, not necessarily, yes.
Yeah, got it.
Yeah, exactly. Yeah, no, that's a good point. It's not from the DEX itself. Yeah. And let me show you one use case of these implied variables and bear markets. So we know, for example, 14th of July, we don't know, this is what we know is coming later. So this was the worst day of our sample. Bitcoin went down 16%, ETH 18%. So we see IV a bit in ETH, in Bitcoin, and in Ethereum. So just the volatility of these two tokens implied it spiked a lot. So it went from 70 to 110, and here from 80 to 130. So large spike, like the VIX spikes when there's some bad news. The same happens here. That's totally to expect it. Let's look at the implied correlation and the implied impermanent loss on this day, basically. And here we see that, for example, the implied correlation basically increases. So because both tokens experience a loss, 16 and 80%, implied correlation goes up. They correlate a lot. And what happens to the implied impermanent loss? It stays more or less calm. Why? Because we have a shock to both tokens, but they decrease at the same time, so the relative price does not really change. So that's why the implied impermanent loss does not really indicate any bad thing here. It stays more or less calm. What happens if one token goes down and the other goes just a little down? So there's hardly a day to find where you have one token goes down a lot and the other goes up. So this was kind of the best example I could find. Implied correlation decreases. Why? Because one token goes down, the other goes just a little down. So implied correlation is not so strong, which leads to the fact that the implied impermanent loss goes up. And this makes sense because one token experiences a large drawdown, the other just a bit. So there is arbitrage happening basically. And this is important because it basically means that this just looking at volatilities of the individual tokens is basically not enough. You can have, it's really important also if they move in the same direction or just differently kind of, which then transponds or transfers to the information in this implied impermanent loss, which increases here, for example, because one of the token went down a lot. Yeah, so this is a bit more concrete, a bit more economics of that measure. Now let me show you in the last 10 minutes about pool sizes and APRs. So basically, there's this paper by Leham Palur, which we probably all know, that pool sizes adjust the size to reach equilibrium, and they kind of pool size balances with the fee revenue with impermanent loss, or what they call it risk of being picked off. And they basically claim that this higher risk of being picked off, which is impermanent loss, leads to smaller pool sizes. Now, these measures, these implied measures, for example, you see they're highly negatively correlated with the TVL of, for example, Bitcoin Ethereum pool. So that's exactly what they claim. This TVL is basically all TVLs where with BTC stablecoin or ETH stablecoin or BTC ETH. So this is not total market. But even there, you see it's negatively correlated, and implied correlation is positively correlated. So high correlation means pool also increases. Why? Because we like high correlation, but we don't like volatility. So this is kind of in line with their story. We also show that these measures can predict the TVL for up to 10 days. So there's some persistency going on. We can also take the implied impermanent loss and the other measures to run a regression of in sample here, but it's also shown out of sample and doing different tests of APR, future APR on these measures, and for at T and also the lagged value to control. And we also show that here, for example, the T stat is significant for up to 30 days. So it means that large implied impermanent loss today basically means that we have larger APRs, net gross APRs. So higher risk today, higher return tomorrow. Interestingly, and I don't show you the plot, but the picture looks super similar if you look at IVs, but you have a negative relationship for IC. So again, you don't like correlations to be low. So the sign is exactly the opposite. And this is going through all the tests that implied correlation basically has the other sign than the others. And
Sorry.
finally, yeah.
So if you can go to the previous page. So when I think about these numbers, what should be my mental model of, let's say, so first of all, these are all V2 pools, right? So how should I think about?
No, it's V3 pools.
This is V3 pools. I got it. Okay.
Yeah.
And then these TVL is the
total value locked. It's just the size of the pool.
Right. Got it. Okay. So how should I think about basically implied, impermanent loss with TVL? How should I think about this comparison with if I just calculate impermanent loss with TVL? Like, what's the benefits of
realized? You mean?
Right. Like,
So yeah. So the realized, if you look at realized numbers here, they will have a similar sign and a similar magnitude. So this is not the selling point of implied correlation, or implied measures is not this table basically. Also, if you look at realized over 30 days or shorter, you get similar values here. The only thing which doesn't work is the realized correlation. There it's almost zero. But these other measures, so realized variance, realized impermanent loss, you will get a really similar story basically. This is more a sanity check for the implied measures.
I did match the realized. Okay.
Yes. What changes a lot is this one. If you try to predict with realized information, it barely works. So you get significance for 1, 2, 3 days predictive horizon, but that's more or less it. You don't succeed, you don't exceed this horizon. And in some cases, it doesn't work at all. So in the predictive framework, the implied measures work better than the realized. In this contemporaneous, it's pretty much the same. Yeah. And also for the cross-section. So, I mean, cross-section is basically, we're trying to answer the question, are these measures able to explain the cross-section of the returns? Also realized measures. So does a larger exposure to a risk factor, which is here, for example, the implied volatility or the implied impermanent loss or changes of them, mean that I get a higher return? And we do this by using Farmer Macbeth, but also other stuff, which is in the paper, robustness, and two-stage regression. First, we do the time series regression for estimating the betas for each point in time on a rolling window. And then we run a cross-sectional regression where we regress future APRs on these betas. Now, what is future APRs? What you see typically in asset pricing, because you have a lot of data, is next month. You regress next month return on the betas. Here we do a bit more. We we do basically a regression for the next day on these betas, for the next 2 days on these betas. So we do this for different horizons. So, which leads us to this picture. So we do it for 1, 2, 3, 7, 10, and 14 days in the second stage. So for example, so which future returns are we taking? The betas are estimated always the same kind of. And the farmer Macbeth says there is for horizons less than 7 days, which is short, but there's also limited data here. We only have 2.5 years or something. There is a positive risk premium. So we have a T-stat below 2 for at least 7 days. So higher sensitivity to these changes in the implied impermanent loss, they earn a higher premium. And if you look at the realized one, I think it's only significant here up to 3 days. But I mean, that's fine. Really interesting is this picture. Now, instead of looking at the implied impermanent loss, we look at the drivers. So this is the implied volatility of the BTC, of ETH, and the correlation. And as suspected, the implied volatilities, they are positively priced, and the implied correlation, even though it's only for 3 days, is negatively priced. And then it's still negative, but not significant, but okay. So again, you don't want negative correlation as an LP or low correlation because you want high correlation, high co-movement. So that's why correlation is actually negatively priced. And this is exactly the opposite as in the equity world. There you would see implied correlation also here. So this is a pretty interesting feature again of this liquidity provision. Yeah. We also do a lot of robustness. As I said, in time series predictions, these realized measures, they don't show that much significance, sometimes no significance. These implied measures also predict out of sample. What I showed you was all in sample. We have a test for non-overlapping sample. And for the cross-section, we also have some other tests, and their realized correlation, for example, does not work so well. Yeah. What we would like to extend the paper in the next step is also to replicate this impermanent loss of Uniswap V3, because basically we took data from V3, we acted as if it's V2 by calculating APRs and everything, because we also calculated the impermanent loss kind of in a V2 way. With V3, things are, as we all know, a bit more complicated. We need corridor variances and everything is conditioned on this liquidity position. Nevertheless, it would be cool to have this. And also what we're working on is the lever, the loss versus rebalancing, replicating that also in an option implied using options data. Yeah, that's the future research. I mean, to sum up, yeah, it's time. The paper basically connects this on-chain liquidity provision, returns and risks to the derivative markets by extracting information from traded derivatives on the two tokens. So we get an expectation of the innovation in the tokens' prices or movements. We developed this mathematical framework which allows us to extract a risk-neutral implied impermanent loss. We can also show that this implied impermanent loss is basically the sum of its drivers, which is the IVs and the correlation between the two. And for doing so, we needed these two tricks, change of numeraire and getting this density via this HD bounds, because there are no index volatility and no options on the relative price. We then estimate these measures using option data. We construct these measures for the BTC ETH pair. And we show that these implied measures are related to pool size, and they explain, for example, the pricing of these liquidity pools in the cross-section. And the results align with the economic intuition that a higher risk leads to a higher return. And yeah, many more results in the paper. Thank you.